Hey, welcome to Current Yield, the Grant's Interest Rate Observer podcast. With me today, as always, Eric Whitehead at the controls, Phil Grant, who runs our almost daily grants, and the great Evan Lorenz, the deputy editor of grants. And also joining us today is John Haskell, who is in the throes, the very fires of the emerging markets liquidation. John is the director of research at Explorador Capital, which invests in Latin America. So he's going to tell us how things look at as it were, ground zero. I must tell you, because it's a commercial enterprise, about our sponsors. We are sponsored in part by SaneBox, which is going to help you take care of that most annoying feature of everyday life in 2018, that is email. And furthermore, we are sponsored in part by Purple, which makes the kind of mattress that will allow even you, John Haskell, to sleep at night, engaged as you are in the emerging market liquidation. And finally, furthermore, and not so fast and notwithstanding, we are sponsored by Grant's Interest Rate Observer, which is having a conference on October 9th. In case you guys heard about this, right? Yeah, this is our 35th anniversary conference. Everyone has to attend. That's the rule of podcast listeners. So, John Haskell, welcome to you. It's a pleasure to have you with us. We thought of you today, John. We are talking to you in the midst of a flaming crisis in emerging markets. And if you didn't know it, John, perhaps you've heard of this. If you didn't know it, everything's going down, including the currencies. Business value has been subsumed through macroeconomic considerations, and it is a pointless exercise to analyze securities. That is the composite message of Mr. Market. And we are calling you, John Haskell, because you have a little different view of the world. And I've known you, John, if I may fill in a little personal background information, from as long ago as your distinguished career at the Harvard Business School. And you went out into the world and done a lot of interesting things. And now here you are at Explorador. Tell us, John, how you see the values that are in your line of vision.
That's right. Well, I have to say, in the short term, in the last few weeks, it has felt indeed like focusing on fundamentals of securities has been a fruitless exercise, because the downdraft that we've experienced in markets like Argentina, have been ultimately a top-down driven macro story or macro consideration. And it does seem that those who focus on fundamentals have all but been overwhelmed by the trading and stop losses of global macro EM traders. I would say, though, over the long run, this is an incredible financial opportunity. And the only way to understand that with confidence today amid all the volatility is to focus on those fundamentals. So I spend my time mostly looking at individual companies.
John, could you give us, just by way of introduction, if you would single out a specific company, say in Argentina, something that has absolutely been pummeled, and in a few well-chosen words, tell us what has happened to the company and what has happened to the stock. Those are two separate and distinct things, and what the opportunity might be.
Sure. Take Loma Negra, LOMA, on the New York Stock Exchange. It IPO. It's a great example for Argentina's euphoria followed by crash over the last 12 months. It IPO'd in November of 2017 on the New York Stock Exchange at $19 a share. It peaked at $25 a share, and it's now down to $7.85. It's lost 69% of its value. Now, Loma Negra is a cement company. In fact, they have 45% market share of all of Argentina's cement industry. Cement is a commodity product, but one that has a lot of pent-up demand in a country like Argentina, which has suffered from a lack of investment for quite a long time. Loma Negra is by far the market leader in this industry. And I don't think cement is a great business necessarily, but cement can be a great investment when valuations trade at a very, interesting level.
How is this valued, John?
So on EV to EBITDA, for example, Loma Negra is now 4.8 times. But maybe the better metric is enterprise value per ton of cement capacity, because this gets to the replacement cost. There will be the need for more cement in the future, and one could just build a new cement plant. But what does that usually cost? Estimates vary, but let's just say no less than $250 per ton of capacity. And in areas with strong NIMBY, not in my backyard, where it's difficult to build a cement plant because of community considerations, it can be as high as $350 per ton of capacity. Now, Loma Negra today, enterprise value per existing ton of capacity is $118. So you're buying a stock at a substantial discount to the substantial effort and investment it would take to build, to replace what Loma Negra already provides.
You know, John, one important consideration during a crisis, I suppose, is the staying power of a business that is in the whirlpool. So what does the balance sheet look like?
So Loma Negra has less than one turn, in fact, 0.4 times net debt to EBITDA. It's practically unlevered. And that comes from a legacy in Argentina of companies that have had traditionally very low access to credit. So companies in Argentina like Loma Negra will survive in times of turmoil just because existing cash flows, which are, high single digits into low double digits, more than service their debt. And the other element here is in a time of turmoil, the appeal of competitors to enter the market through imports is lower as well. When currencies are depreciated and local purchasing power is low, U.S. dollar-denominated importers simply don't have the economics or the incentive to compete against Loma Negra. So their ability to stay, even if times are tough, is high. That limits the downside of an investment in Loma Negra. And the kind of upside you would see is, frankly, just a reasonable re-rating of its multiple, combined with the very visible capacity expansion that's already in the pipeline. They'll essentially grow their cement capacity by 35% by 2020, and that will be meeting some very basic cement demand growth in the Argentine market with factories that they'll already, or plants that they already have that they're expanding just through brownfield.
John, but in terms of expansion to meet a pent-up demand, that's one thing. But the other is that the peso's crashed this year. Short-term interest rates are well into the double digits. And Argentina just now applied for an IMF program. What's the outlook for, I guess, fundamental demand? And how do you think about an investment that is kind of under the aegis of the IMF at this point? What is the catalyst that's going to actually cause this to re-rate and for the market to realize the value that's inherent in here?
Well, first, a quick note on Argentina. Its vulnerabilities looking backward are clear. Its twin deficits, fiscal and current account. When you look forward, though, frankly, with IMF incentives, but also with the existing Macri administration's desires to reform the Argentine economy, this is a country that will now be budget neutral on a primary budget balance, neutral next year, and run a surplus in the following year. So a lot will change there. When it comes to very high inflation, high interest rates are going to essentially conquer that in its Volcker moment. Disinflation will eventually allow for very high real rates, will allow for those rates to come down. So the stabilization of the currency will be achieved essentially from orthodox monetary policy decisions that have worked elsewhere, though painful in the moment.
Yeah.
And then when you think about the underlying Argentine, opportunity, this is a population that's well educated, that has competitive exports.
We have to interrupt this narrative because we have an urgent need to sponsor this program. And I'm going to say a few words about sleep. Now, John, are you sleeping pretty well these days, I suppose? Are you?
I try my best.
Well, you could sleep even better if you had a purple mattress. And, of course, if you turned off your phone at night, that would help too. You don't want to see these quotes. But the watchword here is better sleep, better you, as I think you might appreciate. So the purple mattress probably will feel different than anything you've ever experienced before because it uses this brand new material that was developed by an actual rocket scientist. It's not like the memory foam that one is used to. The purple material feels unique because, the copy says here very unique, but we know that unique does not take a modifier. The material feels unique because it's both firm and soft simultaneously, so it keeps everything supported while feeling really comfortable. Plus, it's breathable, so it sleeps cool. Ends up giving us kind of like zero gravity thing going on. So you're going to love purple. And right now, you can get a free purple pillow with the purchase of a mattress. That's in addition to the great free gifts they're offering site-wide. So just go to purple.com and use the promo code GRANT at checkout. That's purple.com, code GRANT. The only way to get this free pillow is to use my code GRANT at checkout. Purple.com, code GRANT. So that problem is solved, John. John. Now, I would like you to tell us, you've been around not so very long, but long enough to have seen a cycle or two or three in emerging markets. They do come quick and fast. How does this liquidation, I guess it's very nearly a panic, how does this compare with prior cycles of difficulty, and how do the opportunities on offer compare with other things you have seen in your value-seeking days?
I would say that some of the prices we see in the market are on par with past cycles, but the underlying fundamentals are frankly much better off than in past cycles. So sticking with the Argentina example, the peso in Argentina surpassed 40 per dollar very recently. And in real terms, adjusting for inflation, that's a level comparable to 2003 first quarter when Argentina defaulted, when the banking system collapsed, unemployment was 20% plus, and when the administration very much oriented in a different and much less fiscally responsible manner. So I would say today, the peso is cheap in real terms and is implying that Argentina is facing as deep a crisis as it did in 2003, and that's simply not the case on the ground. Now,
tell us, John, if you would please, about other opportunities you see perhaps in Mexico or elsewhere in South and Latin America. What, very quickly, if you would, just the highlights, valuation and business highlights of some of these things.
I'm in Mexico right now. A company that we own is called Vesta, V-E-S-T-A. Its ticker is V-E-S-T-A apostrophe, and it's only listed on the Mexican Stock Exchange. It's a 890 million market cap company. They are essentially an industrial property developer. They have 27 going to 30 million square feet of GLA. Now, these are warehouses, light manufacturing facilities for multinational corporations that invest in Mexico as a manufacturing platform. Their customers are large multinationals like Nestle, Nissan, Bombardier, Lear Corporation. What's interesting on Vesta is that they currently at this price have a valuation that is a cap rate, an enterprise value on net operating income, an implied cap rate of 7.5% right now, factoring no growth. And that compares to 4.5, 4.7 for comparable industrial assets in the United States. And yet this south of the border discount is quite unjustified. Their customers are the same. Their lease terms are, quite strong, 86% dollar denominated. Their average duration is 5.6 years. These are usually 10-year leases committed, and recourse to the multinational high credit rating underlying customer. This company pays a 5.5% dividend yield. It's practically competing with fixed income. And yet, in addition to that present cash flow and discounted valuation, they are in the process of continually developing new built-spec or built-to-suit properties. And they develop at an 11.5 or 12% IRR. So there's a spread and a value creation that they capture. They're also trading currently about 30% below the appraised value of their existing portfolio. So the discount to the existing portfolio, if that eventually closes, is additional upside.
John, about 10 years ago, this is early 2008, the emerging markets were doing rather well, America rather poorly. And Evan recalls, and we have in front of us the copy of The Economist of March 8th, 2008. We have this story that's headed the decoupling debate. And the thesis was that decoupling, meaning, of course, that the so-called emerging markets go one way and the developed markets go another. The idea that the EMs could thrive and prosper in the absence of anything like American growth. And the story wound up, so bits of American business are rising above their own economy. With luck, the world economy can rise above America's. So I want to ask Evan Lorenz first, and then John Haskell second, about what appears to be an opposite state of affairs. So today, the emerging markets, John Haskell, as you might have heard, are struggling. America could not be rosier and more cheerful. And so is this kind of recoupling? Is this other kind of decoupling? Is this?
Yeah, it's decoupling in reverse. America's doing great and the rest of the world's not. In fact, Bloomberg had a story the other day saying that U.S. stocks are beating EM stocks by the most since 1996, which was the start of the Asian financial crisis. The funny thing is, first of all, the U.S. is still linked to the rest of the world, and U.S. stocks are especially so. In 2017, 43% of the revenue that the companies within the S&P 500 generated actually came from not the 50 states, but the rest of the world. So if problems persist, it seems like the U.S. should experience it, or if things are going well, it should also be reflected.
Anyone around this table have trouble with emails, just overwhelmed by it? Yeah, I see a show of hands. Now, I think it was George Will who said that emailing is just like knitting socks, except, Evan, you listening to this?
Yeah.
Except at the end, you don't have any socks. Well, you got a damn email. SaneBox is here to help you. It's got some, well, it's a system, is SaneBox, and it helps you to sort your email. And here's one thing. It's got this. Here's a sweet feature: a one-click unsubscribe, which sends annoying emails into the aptly named black hole. Yes. An automatic tracking of messages that haven't received replies, so that you can see who needs a little slapping around the head just to answer your emails, right? So see how SaneBox can help you reclaim your time and attention with a 2-week free trial. That's visit sanebox.com/Grant, I think, right?
Yes.
Yeah. Today, start your free trial and get a $25 credit. That's SANEBOX.com. It's /Grant. sanebox.com/Grant. Okay, John, I know that you're not principally in the business of macroeconomic or strategic stargazing, but riddle us this one. So America is at new highs, and lots of countries in which you operate are, if not at new lows, then knocking on the door thereof. And what would happen to your stocks if the American equities market stepped in front of a proverbial bus?
Yeah, I think it would be negative, especially companies that are closely tied to the American economy. The Mexican economy is correlated to the United States of America with more beta. So if America turns a negative corner, I think we would see Mexico also go down. The difficulty is that you can buy businesses that store their value in real terms and ward off competition because of barriers to entry, available at currencies denominated in currencies that are fundamentally inexpensive in real terms. You can buy those businesses today. And many of those businesses are not necessarily that closely tied to the prospects and fate of America. You have companies that are serving local, domestic-oriented demand drivers. And those companies can do well in the long run, regardless of the macro cycle. But, I would say it's not just vulnerability, but it's what's already in the price. And
what's cheaper, John, the currencies or the shares?
The currency or the what?
The currencies or the stocks themselves. What's cheaper?
Well, the stocks that are denominated in local currency get both. I mean, you can buy, for example, in U.S. dollars, a company called Arcos Dorados, the McDonald's master franchisor for Latin America. And you're basically buying the largest franchisor in the world for McDonald's. You're buying 2,191 McDonald's restaurants in 20 countries. And on an enterprise value per restaurant basis, you're paying less than $800,000 per restaurant. And, that's attractive because these are restaurants that are, first of all, facing...
What's the comparable figure in America? $800,000 for this company. What would it be?
I have to look up. It's not quite apples to apples because McDonald's Corporation in America benefit from the franchisee, business model in other parts of the region. What you're really buying here are, first of all, just under 500 restaurant locations where you own the land, and the remaining 1,500 you own the leasehold and all the building and equipment. But owning the land, for example, just under 500 restaurants in cities that have grown up around the McDonald's, often in choice property locations, you're getting in total just from the land of buying Arcos Dorados, you're getting in acre terms 255 acres. That's a third of Central Park. So you're buying parcels that add up to a third of Central Park in Latin America's major urban centers. And you're buying the operator of the strongest restaurant brand. And you're buying this on present earnings, but seems reasonable, not necessarily extremely expensive nor cheap. 7 times EBITDA if they earn $250 million in EBITDA this year. But you have to remember that you're buying this in locally denominated currency sales. They are literally the Big Mac index. So pull up the Big Mac index on the Economist website and see the undervaluation of Latin American currencies. And you're buying that business stream at currently 7 times EBITDA, call it 21 times earnings, which is in line with global large restaurant franchisees. But this is very depressed, and there's resilience to the brand and there's resilience to the location. So $800,000 a store, that's cheap. And that's a combination of the currency as well as the local equity market valuation.
Hey, John, thank you. That was a great tour of a crisis-racked region, but it sounds as if the crisis were the other side of the coin of opportunity. I'm going to coin a phrase there, but I'm going to claim that, actually. I'm going to claim it from whoever said it first about 1,000 years ago. But been great talking with you, and I wish you all the fruits of the realization of this value at these crisis levels. And secondly, in context of our advertiser, I wish you a good night's sleep. So thank you, John, for being with us.
Thank you, Grant. Thank you, Jim.
Ladies and gentlemen, lest I forget, we have been eager to receive your questions. We want to know what you want to hear and what you'd like us to talk about and what kind of guests you might like us to recruit. So if you would send your request to podcast@grantspub.com, podcast@grantspub.com. We will take a look and see what we can do. We want to, make you happy. So do it. And ladies and gentlemen, I would be remiss if I didn't toss in as a sponsor us. We have a conference coming. You guys heard about this?
Yeah.
I think we mentioned it once or twice.
Yeah, it's October 9th, and it's our 35th anniversary. In fact, Grants was created before the advent of podcasts. Indeed, I think it was about the same time that radio came in. It was a long time ago. And this is going to be one fabulous conference. Do you guys know that, for example, Stan Druckenmiller is going to be there in person?
Sounds like a...
Yeah, and Bill Ackman and Jim Bianco. Eddie Chancellor is going to talk about John Law, one of the great monetary thinkers of yesteryear, who actually is related through a long string of intellectual connections to Ben S. Bernanke, Ph.D., and Tony Deaden's going to be there, and Craig Moffat, and Logan Wright, and Jace DeSena-Trennert. I don't know, it's going to be, and I neglected, but I shouldn't have, Francine McKenna, who is going to talk to us about the corruption in accounting leading to the opportunity of people who actually pay attention to financial documents to figure out what's going on.
An all-star cast.
Yes. I would say that. It's an understatement. All-star cast. And you guys are planning on attending, no?
What day is that again?
This is October 9th.
Oh,
at
good.
the Plaza Hotel in New York. And it is not to be missed. So I hope to see you, Evan, you, Phil, and Eric. You come too. And ladies and gentlemen, there are still good seats available right in the first base line, I think.
Dugout.
Dugout seats,
yeah.
So do come. See you then, and thank you for listening to Current Yield.